Imagine in 1986, on the financial battlefield, a thrilling war was quietly unfolding. One of the protagonists was Kaiser Steel Corporation, a legendary enterprise that had participated in construction of the Hoover Dam. However, due to soaring labor costs and fierce competition from China, it was now on the verge of collapse and had become a target of a hostile takeover. The acquirer, Bruce Hendry, was eyeing it greedily, intending to dismantle the company for huge profits. On the other side was Fidelity Investments, a rising financial giant on Wall Street, holding the crucial vote that would determine the fate of Kaiser Steel. In this war without gunpowder, what choice would Fidelity Investments make? And how did it manage to reach its current position and become a legend in the financial world? Let's step into the story of Fidelity. On November 25, 1986, on the eve of the shareholder meeting of Kaiser Steel Corporation, the entire financial community held its breath. Fidelity Investments managed hundreds of mutual funds, and its largest fund, the Fidelity Fund, had assets of $65 billion, which came from millions of middle-class Americans. Perhaps they didn't know that their voting rights were concentrated in the hands of Ned Johnson, the CEO of Fidelity. This was a power that could change the direction of American enterprises. At the shareholder meeting that determined the survival of Kaiser Steel, Fidelity Investments made a decision that shocked everyone. They fired the current management team, rejected Hendry's acquisition plan, and decided to take control themselves. This decision instantly changed the fate of Kaiser Steel and made Fidelity Investments even more prominent in the financial world. However, the legend of Fidelity dates back much earlier. In the 19th century, railroads were the lifeblood of the American economy. Union Pacific Railroad Company, as an industry giant, played a crucial role in economic development. However, construction brought about a crisis. The company tried to reverse the situation by building refrigerated train cars, but was hit hard by the San Francisco earthquake, and its stock price plummeted. While everyone was suffering heavy losses, Jesse Livermore, with a precise prediction, sold the stocks of Union Pacific in advance and made a fortune of $255,000, equivalent to $7.5 million today. His story inspired countless people, including the young Edward Crosby Johnson. Edward was born into a wealthy family and originally studied at Harvard Law School following the family tradition. But Livermore's story ignited his passion for stock trading. He resolutely transferred to Harvard Business School and dedicated himself to the financial field. In the 1920s, the American economy was booming and the stock market was thriving. Edward was eager to make a name for himself. However, the Great Depression in 1929 hit like a sledgehammer, throwing the entire financial market into chaos. At that time, many investment trust institutions were unregulated and engaged in wild speculation, causing the wealth of ordinary people to shrink significantly. But Edward was not daunted by difficulties. Through family connections, he met William Parker and joined his company. In William Parker's company, Edward quickly stood out with his outstanding abilities and became the chief financial officer. At the same time, he privately managed funds for wealthy friends and families in Boston. In 1930, under the shadow of the Great Depression, two stockbrokers founded the Fidelity Fund with an initial asset of only $44,000. They seized on investors' desire for safe investments, promoting the Fidelity Fund as a non-leveraged and diversified investment option. In just 3 years, its assets grew to $3.3 million. However, the outbreak of World War II disrupted the rhythm, and the development of the Fidelity Fund stalled. After World War II, the American economy entered a period of rapid growth, and the stock market entered a bull market. Edward keenly realized that in a bull market, sales were crucial for the success of mutual funds. He made bold innovations by hiring third-party professional salespeople to actively promote funds to the public. At the same time, he worked hard to reshape the image of mutual funds, emphasizing diversified investment and making ordinary people believe that it was a reliable investment choice. By the end of the 1950s, the Fidelity Fund had become a major force on Wall Street, managing over $400 million in assets, and its business model gradually became the industry standard. As Fidelity grew, competition became fiercer. To stay ahead, Edward appointed Jerry Tsai, Jerry Tsai adopted the novel strategies of high-frequency trading and technical analysis at that time. He studied stock price charts to find short-term trading opportunities and frequently bought and sold stocks. This strategy achieved amazing results. The Fidelity Capital Fund he managed generated a profit of about 20% annually for nearly 5 years. In the 3 years after its establishment, the fund attracted $100 million in funds and another $100 million the following year. Jerry Tsai's success greatly enhanced Fidelity's competitiveness, but also triggered internal power struggles. Edward had long planned for his son, Ned Johnson, to succeed him. After Jerry Tsai realized that Fidelity always belonged to the Johnson family, he chose to resign and start his own business. His departure led many investors to follow him, causing no small amount of damage to Fidelity. But Ned Johnson didn't give up. He knew that the future of Fidelity lay in continuously discovering new talents. In the 1970s, the American economy fell into stagflation, and the stock market entered a bear market. The mutual fund industry was hit hard, and Fidelity was no exception. In this difficult time, Ned Johnson took over as the CEO of Fidelity. To save the company, he actively expanded the money market fund business to provide a stable source of funds for the company. At the same time, he searched far and wide for talents who could revive Fidelity stock mutual funds. That's when Peter Lynch came into his sight. Peter Lynch had a difficult childhood. His father died of cancer when he was only 10 years old, which made him understand the importance of financial freedom and early age. After graduating from the Wharton School of Business, Lynch joined Fidelity as a research analyst. During a period when everyone was losing money, he built an outstanding stock portfolio with his unique investment vision and gradually stood out in the company. Ned Johnson recognized his talent and appointed him as the head of the Magellan Fund. Lynch's investment philosophy was very different from Jerry Tsai's. He didn't pay attention to the short-term fluctuations of stocks. He firmly believed that as long as he had a deep understanding of the businesses of the invested companies and selected those with potential but not yet discovered by Wall Street, the stocks would perform well. His investment method required a lot of on-the-ground research, but it achieved great success. Under Lynch's management, the Magellan Fund outperformed the market almost every year for the next decade, with an average annual return of nearly 30%. Since 1977, the return rate of the Magellan Fund has reached 2,470%, while the return rate of the Standard & Poor's 500 stock index during the same period was only slightly higher than 500%. Lynch's success not only helped Fidelity out of the mire, but also strengthened its position in the financial market. However, in 1990, Peter Lynch suddenly announced his retirement, shocking Wall Street and posing a huge challenge to Fidelity. To make matters worse, in the following 3 years, several Fidelity executives were indicted for junk bond-related schemes, seriously damaging the company's reputation. At this critical moment, Ned Johnson pleaded with Lynch to return. In 1992, Lynch returned to Fidelity, but he no longer managed the Magellan Fund. Instead, he served as a brand ambassador, working only 2 days a week. His return stabilized market confidence, and Fidelity gradually emerged from the crisis. As time went by, Ned Johnson began to groom his children to take over the company. Abigail Johnson didn't seem to be the most promising successor at first, but she had excellent sales and communication skills. In 2001, she attempted a coup, secretly gathering key shareholders of Fidelity in an attempt to remove her father from the CEO position. Although she failed, her determination and decisiveness won her father's respect. In 2012, Abigail Johnson finally took the helm of Fidelity, becoming the leader of this trillion-dollar empire. Today, Fidelity Investments has become a giant in the global financial industry, managing nearly $8 trillion in assets. As a private company, it is still controlled by the Johnson family and has a huge influence in the global financial market. From the acquisition decision of Kaiser Steel to dealing with various market crises and continuously cultivating talents to drive the company's development, the story of Fidelity Investments is a legend full of challenges and opportunities, inheritance and innovation. It has witnessed the ups and downs of the American financial market and provided valuable experience and lessons for the development of the global financial industry. In the future, Fidelity Investments will undoubtedly continue to write its glorious chapter in the financial field.